Hello, everyone. Welcome to Moneycorp's webinar on the pending U.S. elections and what we should be looking for and what we'd expect. It's my pleasure to welcome a former colleague, Mickey Levy. Mickey was the former chief economist at Bank of America. He's also a long-standing member of the Shadow Open Market Committee. He is also a visiting scholar at the Hoover Institute at Stanford. Also want to welcome Eugene Epstein. He's a colleague here at Moneycorp. He's the head of our structured products group and the head of our trading group. So very topical today. Obviously, the election's only 15 days away, so a lot of people are on the edge of their seats to figure out what's going to happen and what's going to transpire. Mickey's going to offer some insights on what we should be looking for in the market, potential volatility and impacts on the overall market. Eugene's going to go through from a structured solution standpoint, what does that mean for you? Is there ways to minimize your risks? And then lastly, we'll save some time at the end for some Q&A. Just a couple of housekeeping things. Everyone's muted on this call except for the three of us. There's a Q&A box that's open so you can ask questions on the chat. The views expressed here are from the speakers only, not necessarily Moneycorp Group. And then lastly, this will be recorded and we'll be sending it around afterwards to those who registered, so you'll be able to listen to it afterwards. So with that, welcome Mickey, and I'll leave it with you.
Tom, thanks so much, and I apologize for the delay. So just at the outset, it's just so important that this presidential election outcome in the U.S. has significant economic and financial impacts on the U.S. and particularly globally. So I'll try to stick to the fundamentals of economics. So taken at their face value, both presidential candidates, Harris and Trump, their economic platforms are decidedly negative for U.S. economic growth and global economic performance. And we don't need to go into it here, but neither platform addresses the U.S. mounting government debt, and they seem to be geared more toward buying votes than anything that's economically rational or strategic. So another critical important point is the actual economic policies that the next president will be able to achieve or depend critically on the congressional elections and whether the power is split between Democrats and Republicans. For example, Harris' victory, combined with Republican control of the Senate, which the current polls, I think, Eugene can fill us in on this, currently suggest would soften Harris's most onerous tax hikes. Now, keep in mind, so we have all these conditional probabilities on who wins the presidential election, who gains control of Congress, and this makes it really a dicey situation. So so the key point to bring out, and one of the things I'd like to emphasize here, is regardless, even if you have a split power with, say, Trump becoming president and Democrats controlling, let's say, the House of Representatives, the power of the president is very, very strong. Remember back to when President Trump was elected, and he was able, through executive order, to impose significant tariff increases without any support from the Congress. Now, so let me give you a backdrop on, just a few, what's going on in the economies. The U.S. economy has been quite resilient, with growth that has been above standard estimates of potential. Current Q3 GDP by the Federal Reserve Bank in New York nowcast is about 3%, and inflation stuck at about 2.5% on the CPI, expected to be stuck there through year end. Now, looking at, it's not just the U.S. consumer that's been strong, but also over the last number of years, you've had very healthy gains in business investment that have been very heavily driven by software and R&D. That in part has been driven by President Biden's government stimulus that's provided financial incentives for manufacturing semiconductors and battery plants and the like. So you have consumption driven by employment, modest increases in wages that has increased disposable income. And then at the same time, in addition to that support for consumption, you've had a tremendous increase in household net worth. And so you have spending continuing, and then by consumers at the same time, businesses are spending. And right now, a critical point to bring out is when you look at the U.S. economy, you don't have major imbalances in it. Businesses have inventories under control. They haven't hired too much. You don't have a hangover in employment. And then once again, the U.S. has the highest potential growth among all major advanced economies. Now, as you also know, and this is important to think about the election outcomes, Europe's economic growth is notably weak, particularly, German economies is faltering. And at the same time, China's economy, and I've written about this a lot, is much weaker than their official data suggests. They have a negative wealth effect driven by the collapse in real estate that was generated by the government's excesses. The reason why it's important to bring this out, when Trump as president imposed his beginning of his trade wars with China, that was in mid 2018 when the global economies were much stronger. Now they're not. So any imposition of tariffs would come amid much weaker economic growth and could have a larger impact. Now, getting back to the election, every 4 years since 1992, I have analyzed the economic platforms of the US presidential candidates. And what's so striking about these two candidates we have in 2024 is they're much more polarizing than any time in the past. If you do not a side by side, but look across election periods, Harris's economic platform is very similar to Bernie Sanders in its high taxes and high spending, and incorporates price controls in, and and also her proposed tax on unrealized capital gains could be quite jarring. On the other hand, Trump's proposals are not traditional Republican. They are for kind of controlling spending and cutting taxes. But he includes, it's not traditional Republican. He proposes a significant increase in central control of the government. It's not free enterprise. It's central control, including the notions he said about trying to have an impact on the Federal Reserve, which he will not be able to do except through appointments. And even if Trump is elected and able to nominate certain people for the Federal Reserve, that would have to be approved by the Senate, going through the Senate Banking Committee. And that's what's crucially important for the congressional outcomes. So, let me go on and just, quickly give you some of the highlights. So, Harris proposes increasing current individual rates, the highest rate from about 37% to about 44%. She would let the 2017 tax cuts expire. Critical point to bring out here, and this is to help you avoid confusion. The 2017 tax cuts are due to expire in 2025. If they're allowed to expire, it has no change on this Congressional Budget Office's forecasted deficits and debt. Trump, on the other hand, would have them continue, which would in effect be no change in current tax law, but they would be measured as a deficit increase because the current CBO's estimates are based on current law, which has those expiring. I hope I was clear on that. So Harris would have significant increases in taxes on everybody with adjusted gross incomes less than 400,000. She would raise the corporate tax rate to 28% from 21 and set minimum taxes on U.S. multinationals. And then on the spending side, significant increases in housing, child credits, social programs. Trump, on the other hand, would extend the 2017 tax cuts, lower the corporate US tax rate to 15 from 21, and then other goodies. And he talks about increasing deficit spending, but he doesn't provide any specifics at all. Whereas Harris, who's, basically adopted most of President Biden's economic proposals, went along with cuts in defense. Okay, and we don't know how all this is going to sort out, but it's in this regard, Harris is very typical. But then she goes further than that. She would rely very heavily on price caps to control price gouging, which obviously creates tremendous inefficiencies. She's aggressive use of regulations, anti-business. But then Trump, on the other hand, has talked about significantly higher tariffs. Now, keep in mind, let's be honest here. A tariff, basically, companies are assessed tariffs on things they import. And companies historically, US companies, have passed on a good portion of those import tariffs on consumers. So consumers end up paying the bill. And there have been a lot of people talking about, how Trump's tariffs would increase inflation. They would have a one-time impact on inflation, but not, it would roll through after a couple months. It would have no impact on longer run inflation. That depends on the Fed, but it would be definitively negative for the US consumer. Okay, and we also have to keep in mind, once again, the international context. Recently, Europe and Canada have imposed high tariffs on imports of Chinese goods. China has threatened retaliation, but nothing yet. And so we can expect if Trump imposes tariffs, there would be retaliation. And once again, it comes at a time when the global economies are much more fragile. So once again, we have this distinct polarization of the candidates' economic platforms at a time when the US economy is humming along. I think there's you've seen a pickup in productivity. Technologies are just coming out the woodwork, AI and everything else. And unlike the second half of the 1990s, when there was a productivity boom, the AI and the other innovations in pharmaceuticals, everything else, are being implemented into commerce and society very, very quickly. And at the same time, since the year 2020, there's been 9 million new immigrants to the US, and they're starting to increase labor force. So the outlook for the US is pretty good. But then you have these proposals that are distinctly negative. And let me offer you a punchline from an economic perspective. And it's the following. Both Harris's higher taxes and Trump's higher tariffs, which would operate as taxes, would lower expected after-tax rates of return on dollar-denominated assets. And this quite naturally should be, in an economic sense, associated with lower real interest rates, that is, lower expected rates of return on capital, and a weaker dollar. So it should reduce the real rate of interest and exchange. Now Eugene's going to provide us more of the detail on that, but that's what the economics tell us. And you would expect under Trump international retaliation. He's also, and I left out something critically important that he does have in his economic platform, and that is deportation of immigrants. It would seemingly be impossible to implement, but even if he were able to, it would be negative for the economy. And so now let's get to this congressional election outcomes. So the House Ways and Means Committee originates all tax legislation. So let's say Harris is elected, but Republicans maintain control or gain control of the House. Then she could propose all she wants. But if the House Ways and Means Committee is Republican controlled, even by one seat in the House, then there would be no tax legislation. If Harris is elected and Democrats maintain control of the House, but Republicans gain control of the Senate, which the current polls suggest, then the Senate Finance Committee could block a lot of Harris's tax proposals. Okay, and soften things. So you would end out with a halfway negotiation on the 2017 tax cuts. So that's exceedingly important. But a critical point to bring out here is the following. Harris does propose dramatic increases, not just in the marginal rates, but she would tax realized capital gains as ordinary income. So that rate would move from 23.8% all the way up to 44%. And her proposal to tax unrealized capital gains, that's only on very, very wealthy people. And you might say, no big deal. However, I would point out the following. Since 2010, right after the financial crisis, household net worth in the US, stocks, bonds, real estate, everything, has gone from $60 trillion to $165 trillion. And there are thousands of family offices and individuals that are sitting on tens of trillions of unrealized capital gains. Okay. And some of them may have to be into forced sales to pay taxes. Now, the question is, even if Harris proposes that, will markets wait around and see what happens, or will they lighten up? And this is a behavioral issue, but it's really quite important. So when we add all this up, let me go on to a critical point. I put this in a PowerPoint that I think you'll have access to. The executive branch is very powerful. So you'd say, okay, let's say there's split power, Trump wins and Democrats maintain control of the House, or Harris wins and Republicans gain control of the Senate. The executive branch is very powerful, and they could, through executive order, put through, in Harris's case, tons of regulations, or through, in Trump's view, he could put through a lot of tariffs. Remember, in 2017, all of those tariffs he put in place, the tariff wars, were done by executive order, his interpretation of Section 232, without Congress. So fasten your seatbelt here. So now I'm going to just, before I conclude here and pass it on to Eugene, I was thinking of the following. Let's consider 4 alternative outcomes. And I'm thinking in terms of how you would hedge risk and amid these election uncertainties. The first is a Harris win and Democratic sweep. Second, Harris win and Republican maintain control. Third, Trump wins, Republican sweep. And fourth, Trump wins and Democratic control under either the House or the Senate. Okay. I would argue, and Eugene, you can agree or push back. I would say under any of these circumstances, any of these 4 alternatives, I think the dollar is going to weaken. Once again, either through higher tariffs or higher taxes. It's going to slow economic growth and hurt global at a time of weakness. There's a fifth alternative, and that is a contested election outcome. And when we look back to November 2000, when it was contested for about 3 weeks, the dollar kind of moved sideways. But this is a different environment. Now, on the stock market, I'd say the alternative one, a Harris win and a Democratic sweep. There, you would want to hedge against a decline in the stock market, hedge against a large decline. On the other alternatives, split power or a Trump win and Republican sweep, I don't think you'd need to hedge the stock market. But the currencies are quite vulnerable. But I wouldn't, going back, if you look at when Biden won in 2020, even though he was able to increase taxes, the dollar appreciated. It went down a touch after Biden won, and then has been strong. When Trump won in 2016, you had a couple months of appreciation, and then the dollar depreciated a bit, and then the stock market went up overall.
Mm-hmm.
So don't overdo the hedging, but and then I'll pass this to you. I think the bigger risk is Europe and the Middle East, and those are economic issues, and particularly Ukraine and the possibility for downside risk with a Trump victory is for real. That could affect Europe. The Middle East, which is just a hornet's nest. I would say a Harris victory, the biggest loser is going to be the United States, because she's really on the fence on a lot of issues and not very assertive. So look, I've covered a lot of ground. Let me stop there, and you,
Sure.
please help us out on some of the technical strategies.
Happily. Well, the way I would look at it is, right, like you can approach this two ways, right? You can approach it as, do I hedge for a specific outcome that let's say as in, let's say any of the clients that are on this call, that I think may happen, or do I hedge regardless of outcome, right? That's really ultimately the question, because ultimately, that's kind of really the concept of hedging. And to begin with is, at the end of the day, most people on this call, you're not, meant to be, hedge fund traders or heavily view taking market participants. The idea is, how do you cover yourself? And so I would argue the perspective more than anything else should really be, not, let's say, speculating on any one particular outcome as, likely. Obviously, everybody has their views, everybody has their opinions, but ultimately, I would argue what's important is just to be protected, period, right? So, part of that is understanding kind of just market momentum and how we've gotten to where we are, and also kind of market psychology, because, like personally, I'm a very mean reversionist type of market player, meaning, I often find that markets tend to get very ahead of themselves, leading up to an event, and then often there's a move in the opposite direction once the event is out of the way. That's commonly known as buy the rumor, sell the fact, for those who are familiar. So we actually kind of had that in the first go around when Trump won, surprisingly, right? When Trump won, that was a surprise to everybody. Markets tanked. There was a huge risk off, and then not long after that, it reversed, and there was, it was pretty much a positive risk, environment for a very long time. So, I'm personally sensitive to that happening, and this seems like it's kind of happening again, because if you look at it, up until today, Trump's odds in the polls have gone up, and there's been a direct correlation in the dollar strengthening across the board. That may continue happening into the election, and let's say he does get elected, the quote unquote Trump trade might reverse just because people tend to get panicked one way leading into, an event like this one. So I think a good background on that is how we even got here, right? So if you look at the last, I don't know, I guess maybe it's a month or so, and I can show everybody here real quick. This is the Bloomberg Dollar Index, so it's just like a basket of currencies. So the overall idea of how strong or weak the dollar is, right? So overall, the dollar's chart, so to speak. So pretty much since the last Fed decision, we've had a complete unwind. So dollar's gotten quite a bit stronger against a whole bunch of different currencies. That's all right here. And if I zoom in on that, the Fed decision was on, I think, September 17th, I believe, and it's been pretty much a one-way street. So, that's obviously a number of factors. It's not just Trump, but the numerous items go into that, and the Trump, odds having gone up, certainly a factor in that, right? So basically, you had the Fed cut 50 basis points, which kind of caught people by surprise a little bit. I mean, it was kind of like a 50-50 shot, but that's, ultimately that was still a little bit more than most people were expecting. So, suddenly the dollar initially weakened, and everybody got very dovish, is the term, right? Thinking that the Fed's going to be super accommodative, and the narrative that the Fed has basically had up until that point was, employment's weakening in the U.S., inflation is under control, so the Fed has to switch gears, basically go from being very constricting the economy essentially with high rates to being accommodative. And again, the narrative that they created in a lot of their decisions and their statements was ultimately the economy is needs some support. It's not in a bad place, but we see things turning a little bit, so we want to get ahead of it and create the soft landing, so to speak, that they talk about, right? So they create this whole big narrative that not every, but a lot of Fed speakers go on TV and talk about, and kind of get everybody on their side. And since then, we've had the complete undoing of that, right? So we had the Fed decision on September 17th, I believe. And then since then, we've had one U.S. non-farm payrolls reading in the beginning of October, which was much stronger than expected. So that's starting to kind of get the employment weakness, perspective out of the frame, basically. Now, since then, we've also had a CPI print, which is effectively, a way that most people read inflation. Obviously, the Fed has their different measures. They have PCE, they have super core, whatever you want to call it. But the point is, it's still a general top line indicator for inflation that a lot of people look at. CPI came in stronger than expected. So now the Fed's 0 for 2. So employment is actually not as weak as they're saying that it is. Inflation is not as under control as they're saying it is. So now the market's reversing, saying, okay, maybe everybody got ahead of themselves, that the Fed's not going to be nearly as accommodative as we thought, going into, the end of this year and the beginning of next year. So a lot of the odds have shifted quite a bit. So that's partially contributed to, the dollar getting stronger everywhere. I'll show you right here, we have like U.S. 10-year treasuries. I just lost it. Sorry, 1 second here. U.S. 10-year treasuries have basically, the yields have reversed quite a bit. This is basically, I'll show you, here's a 60-day chart of the yield in the 10-year treasury. So it went sub 4 for quite a bit of time, meaning everybody's buying treasuries thinking the Fed's going to lower policy, and now it's 4.15, and it's actually almost at 60-day highs essentially, right? So you had a full reversal effectively of the outcome due to the Fed. And when you add the Trump portion or the Trump trade portion onto it, that has further strengthened the U.S. dollar on top of that. They're additive factors, right? So the idea behind, I think, the Trump trade, which is worth discussing, right? And by the way, I say Trump trade as if there's a general understanding of what that is. Frankly, that's debatable. Even sometimes it's more a matter of what the market's perceiving versus what it actually may be, right? So it's a themes question. So right now the theme is, if Trump imposes all the tariffs that he is saying that he will, which is a big if, by the way, again, no disrespect to Mickey, putting economics aside, just market sentiment. The idea is that higher tariffs equals higher inflation. Whether or not that's true, again, is debatable, but that's the theme that's going on right now, right? And that's what's moving the market. So the idea is, with a Trump trade, you have potentially higher inflation due to tariffs. Whether or not you have an opinion on the federal debt, while Trump a lot of times says that he wants to cut spending, the amount of tax breaks that he's suggesting would it's hard to see the deficit not getting bigger. Let's put it that way. Under his presidency, it did get bigger. Pretty much under every president, the deficit gets bigger. So, that has implications for higher rates as well. So the idea is that that Trump might institute, a set of policies that may force the Fed's hand into creating, maintaining higher interest rates for longer, which is the opposite of what they've been implying they would be doing, right? So you have they have the idea of the Trump trade combined with this reversal in economic data that has really been the primary two causes of the dollar getting much stronger to the point we're at now. And you add in what's going on in the Middle East on top of that. Typically, U.S. dollar gets stronger when there's, flare-ups. You have this kind of trifecta of, things that are causing the dollar to get a lot stronger. So that's basically where, why we are where we are now, where we've gotten to. And, I'd argue, question is what happens after. So again, I still think that certainly, while all these moves may be justified, to have such a large reversal in the span of really a couple weeks, which again is directly related to the polls, and that's actually something I showed earlier. Polls have obviously gotten a lot better for Trump, but it's really more the prediction markets, right? There's an online betting market. So you have here, for example, you have one place, Poly Market, which has gotten quite popular, and one called Cow Sheep. The point is that they all have, the betting markets at least, all have Trump on top. I know 56% chance at Predicted, 62% chance at Poly Market, which is like, if you look at, that chart, which I don't know if I can open it here or not, you look at that chart, those odds have been going up quite a bit over the last couple of weeks. So all of these things are really directly causing, I was going to do the 1 month here, have directly been causing the dollar to strengthen because Trump's odds have gone up. So the point is, whether it's right or wrong, those are really the effects on why, or really the rationale as to why the dollar has gotten much stronger since the last 2 weeks or so, right? So the question is, again, to what degree do you hold on to that? Because certainly, as someone who believes in the buy the rumor sell the fact idea, you can totally see this being a big unwind happening into the election, right? You'll get the dollar get even stronger over the next 2 weeks or so, and then let's say Trump does win, for example, have it completely unwind afterwards, which is again by the rumor sell the fact perspective, which certainly can happen. So the perspective that I have is, you can try to speculate on what's going to happen, where the dollar is going to go, whether the buy the rumor sell the fact is really what's going to happen, right? These are all conversations on betting on where the dollar is going to go, depending on the outcome and depending on how the markets move to date. But the other side of the perspective is hedging, right? And I would argue, hedging really is a different way to look at it. Hedging is, well, taking your personal views out of the picture and saying, okay, well, regardless of the market reverts, regardless of the market extends, I have risk in my dollar position. And on this call, we have people that are have risk in a sterling US going lower, people that have risk of euro US going higher, dollar CAD going lower, dollar CAD going higher. So there's a large range of clients concerns really. So I would argue it's not so much on where do you think the market's going to go. The question is, do I protect myself or not, right? And question is, what's the purpose of hedging, right? Hedging, you can think of hedging as basically insurance, right? So it's effectively, most of the people on this call have currency exposures going out to the future. They know that hey, I have to make a payment in a foreign currency or repatriate funds in a foreign currency 6 months from now, 7 months from now. Is now a good time to hedge my risk? Should I hedge my risk, etc.? So there's different ways, obviously, in terms of the products that are offered, right? We have spot, forwards, and structured products. Those are the main categories of FX instruments that Moneycorp has, but also, really any FX provider has, including banks, right? So a lot of clients, they just strictly use spot. And, I understand that perspective. Often, markets are volatile. You don't want to, you want to maybe be more opportunistic, but, it has limitations, right? Because for example, if you just transact spot whenever you need it, you're completely exposed to future FX risk, right? You have no protection. You just, say, hey, 6 months from now, I need to buy X amount of euros. Wherever it is, I'll buy it, right? Which is fine if you think, let's say, it's going to move in your favor. But if you don't know where it's going to go, and you significantly affect your profit margins if it does go higher, as an example, then you probably should be protected, in advance as soon as you know that cash flow. So the good thing about spot is you have full participation, meaning if, let's say, the market does move in your favor, you can just buy spot when you need it. But again, that's if that happens, right? It could go completely the opposite way. We've had some clients, what they do is, let's say you're a sterling US seller. Obviously cable, we call it cable, but sterling US has gone up quite a bit in the last, couple weeks and months, really. You say, okay, when a FX rate goes into my, favorable level for me, I'm basically going to just buy spot, do my spot transaction and hold on to it. Which, again, there's negatives because ultimately you're tying up capital for an extended period of time unnecessarily until, you don't need those funds yet. You can hold off. So that's one thing. And, depending on if you have a foreign bank account, you're also potentially foregoing any interest on that conversion, right? Because now you have foreign currency that you're holding and you might not need it for 6 months. You might not have a place to put it to actually earn any interest on it. So, just doing a spot transaction when the market's in your favor, waiting for the future cash flow to happen is probably not the best strategy, I would argue. Many of our clients and many clients in general use forwards, which I would think most people here are familiar with, but ultimately forwards are just an agreement to exchange one currency for another at a future date. Simple as that. And forwards are they're definitely that's the first kind of hedge. So there's nothing wrong with forwards in that regard. If you know a future cash flow, you have a future exposure, you're locking in a rate now, you can basically safely know what your FX rate is going to be at that time period, and you can forecast that into your profit, future profit expectation, let's say, or lock in a profit. So certainly fine. And you have full protection against rate movements with the forward, which is also great, right? Whether spot moves up or down, you know what your future rate is, and that's it. So that's good. And again, the other thing is there's no long-term tie-up of capital with a forward the way it'd be if you did a spot transaction and held it. So all good things with a forward. It's the most vanilla kind of hedging there is. Nothing wrong with it, far from it. It's the least risky type of hedging. Let's put it that way. The only downside, and it's particularly relevant for this election, by the way, is there's zero participation with a forward, right? If you right now decide, hey, I need to buy euros 6 months out, and you say, you know what, I'm just going to lock in a forward. So regardless of Trump wins, Kamala wins, whoever wins, whether the Senate is green, Senate is blue or red, doesn't matter. I'm fully locked in. So, that's great. But what if, we're expecting a lot of volatility ultimately, right? I mean, that's really the nature of this call and the nature of what people are concerned about. Regardless of who wins, there's probably going to be a lot of volatility. So, leading into this specific event, there's a lot of concern that, if I lock in a hedge, well, what if I was premature in locking in a hedge? What if the market actually moves in my favor and I'm sitting there kicking myself like, well, I just locked into a 6-month forward in euro at, I don't know, 110, 111, and spot comes off after the election, euro, let's say dollar gets even stronger, and suddenly if I waited to buy my forward would have been an even better level, right? So that's one big limitation with the forward, because simultaneously, while you're protected, there's no participation if the market does go in your favor. And that's kind of where my world primarily comes in as structured products, right? So structured products are they're more complex products, but really the idea is, they're more bespoke to and custom to hedging than really forwards are at all. Certainly, we can have a strip of forwards that's a specific date, specific time, but the risk profile of forwards is very, very, very vanilla. With structured products, you can customize hedging a million different ways. That's really their benefit, is because every client has their own type of specific risk exposure. There's no one size fits all. And so, when you provide your notionals, your maturities, what risks you're happy, what risks you're not happy with, that's when structured products really shine, because then we could really customize things to really unlimited range of combinations. So generally speaking, with structured products, right, you have full or partial protection on future, adverse movements in FX. So again, it's still still hedging products, right? You're still protecting yourself. There's a wide range of risk associated with a wide range of products, but ultimately there's still the conversation is still about protection and still about hedging, right? Structured products, there's no tie up in capital like there would be if you did a spot trade. So similar to a forward, you book out a bunch of hedges going however far you want to go, and there's really no need for exchange any kind of cash flows until those hedges actually expire and mature. The main thing again that I argue, given what's going on, given the event coming up is that protection aspect, the participation aspect, the ability that, if the market, if you, let's say you do make the wrong call, which is anybody can, even the highest professionals right now, nobody really knows what's going to happen. You still have a window where, you know what, if you're a buyer of euros, well, let's say euro does go down, you might still be able to participate in a more favorable euro, right? You don't completely give up participation just because you locked in some insurance, right? So that's one major benefit that structured products offer that none of the others do, is the ability to participate, really. And I mentioned, but there's a very wide range of risk tolerances, right? So whenever I'm on a call with a client, I show a range of products, and I organize them by least risky to most risky. Forwards are by far the least risky. Like I said, not that there's anything wrong with that. They're just the least risky, they're the most vanilla. But every type of hedge has their own pros and cons, and it's all commensurate with what level of risk your client is comfortable taking. So you don't get that in forwards. Forwards are just forwards.
Sure.
And the very last thing I'll say is that I say almost typically most important of all is the rates that you get on hedges can actually have significant outperformance versus spot and forwards. So you can actually, depending on your currency pair and the direction, which can have a major effect, you may be getting hedging rates far better than prevailing spot rates, or far better than prevailing forward rates, at the trade inception date. So, Tom,
great. So we have a bunch of questions from the audience. I'm not sure we'll get through all of them, but I'll try to summarize a few. First couple of questions are fairly similar, and we covered a bunch, but one of the primary ones that came in is around a contested election. The last time we had one was in 2000, Bush versus Gore. What does that mean for volatility, and what does that mean, for currency direction, the markets, et cetera? Good, bad, indifferent, or somewhere in between? And I guess I'll put that probably to Mickey, I guess.
Well, I can start out and say, in the year 2000, when it was contested, the dollar didn't move much. The stock market went down and then appreciated, but this is really a different era. So I would say higher volatility, definitely, a lower stock market. But Eugene, you tell me about the dollar.
Well, I would say this, like, the market doesn't, typically speaking, not just currencies in general, markets don't like uncertainty, right? And so when you have a contested election, that's typically, that's uncertainty, right? So in principle, the initial response would probably, I would argue, be more of a risk off, which is considered typically, buying US. But this is a nuance, right? Because this is very much, there's a strong effect on the US dollar specifically from this event, not just some indirect risk off from like a Middle East conflict, for example. So, you would certainly expect some volatility in that case, but then, after the initial volatility dies down, depending on how long that's contested, and I forget exactly how long Bush Gore was, but I believe, that lasted for what, like a month, maybe more. I forget. It was quite a bit of time. I would argue after the initial kind of choppiness, maybe for the first couple of days, it would actually be pretty quiet for a while, honestly, because really, if we're at a point where something can go, one way or the other, pretty much, by a hair, ultimately that's low volatility, right? I mean, it really depends on the nature of that contest, right? Congestion, I guess, if that's even a word. If you think about what happened in the last election, right? Make the argument that, there was a large contingent of people in the U.S. Who believed that the election outcome, or didn't believe the election outcome, and the market didn't like that either, right? So really, like I said, it's initially it's probably some volatility, but it also really depends on the nature of how that election is contested. Is it contested because something like there's hanging chads in Florida and there's a debate on how they're being counted, or is it being contested because a whole slew of people don't like the outcome and they're protesting, right? There's different ways to kind of, you can consider them different contestions. Again, I don't know if it's a word, but you see what I mean, right? So really, I think it has to be more specific about the nature of how that's going down, to know if it's going to be a fear sentiment in the markets, across markets.
Okay. Another question is, in the medium term, I'm not really sure what people consider medium term, but what if you were to force rank the kind of geopolitical events out there, what would be the most important? And the ones given were tensions in the Middle East, U.S. elections, Fed hikes, corporate earnings coming up, gold hitting new highs, crypto closely hitting new highs. What are kind of the force rankings that the market should be looking at in the medium term?
Let me take that. The election, I would put very, very high because, let's say Trump wins, everybody's going to expect these huge tariffs, and then everybody's say, oh no, we're going to have to start putting it up with Trump's tweets at 3 a.m. On the other hand, a Harris victory, the Democratic leadership was about ready to deep six her, and then Biden was forced to step down, and she's shown to be a very effective campaigner. But I quite frankly don't know if she really has thought through a lot of the policies that are in her platform. And so she would have to prove herself as a president-elect. So that's very important. And of course, we all know that if Trump is elected, it means potential problems for U.S. funding for Ukraine. Okay, I would put the Fed very, very high. Eugene showed a great chart there, and the backup in like the yields on the 10s from beginning in mid-September after the Fed moved 50, that was driven by the strong employment number. Okay, so look at that chart. Driven by the strong employment number. Okay. The higher inflation and retail sales. And by the way, let me point something out. I know most of the Fed members. I interact with them a lot. I was with a handful last week, and guess what? They don't know how to forecast the economy. They don't have any better insight than anybody in the marketplace, which means we're all very data dependent. Okay, that's critically important. Okay, and then I wouldn't put corporate earnings up there as high. You see how the market moves on a retail sales number or whatever. Fed very high. Gold and crypto are gonna move with international turmoil, and I would put, this side of Ukraine. Well, Ukraine's in trouble. This side of Iran, using nuclear on Israel. I don't think the Middle East is going to really shake markets. I think it's going to be, the election and then market expectations. But then, so Eugene talks about the initial impacts, and the market says, oh, I think we've got a beat on things. And then it could be totally offset by the next number that comes out on the U.S. economy. Gene?
Yeah, no, that's a fair point. And one thing I actually forgot to mention is, it's funny, right? Like it's the market can really handle only one major theme at a time. So I mentioned before that, first it was economic, and now the Trump trade, which everybody was, by the way, the Trump trade everybody was talking about when it was still Trump and Biden. Biden got, the kibosh put on him, whatever you want to call it. Biden's gone, Kamala's in, and the odds shifted completely, right? So the odds shifted significantly towards Kamala, actually, for a period of time. As soon as that happened, nobody's talking about the Trump trade, period, at all. So now everybody's talking about it again. And after that, everybody started talking about the economic numbers. Now Trump is in the polls again. People are kind of putting the economic numbers to the side and talking about Trump again. But, really, what really led this move stronger in the dollar initially was based on pure economic numbers. And I mentioned before, we had a stronger than expected NFP. We had a higher than expected CPI. Mickey said retail sales last week, stronger than expected. I think initial jobless claims were weaker than expected. So you have all these economic numbers that are still pointing to maybe the Fed getting a little ahead of itself, and the market's kind of ignoring them. One thing that's really interesting to note, and again, this is, if you're going to hedge anything, you hedge this. If you think about the week of the election, and really starting with the Friday before. The Friday before election week, we have the second non-farm payrolls print, since the previous one, and basically the Fed's going to have two non-farm payrolls prints to digest essentially, which is not very common before a meeting. You basically have the election on Tuesday, and then you have the Fed decision on, I believe, on Wednesday. So in a span of 4 business days, you have a bunch of events that really on their own would be pretty big deals. You add them all together, I mean, that's a lot of potential volatility. That's a lot for the
So,
Fed to digest, later in that week.
so that kind of
Hey,
ties
Gene,
into, go ahead.
I was just going to make one other point besides the Fed. You know, not Fed is its forecasts are not reliable. The other point I would make is if Harris is elected, she's going to have to prove herself, and that might take a while. On the other hand, if Trump is elected, we all know he's unpredictable. Okay, so he could do some 180s on us. For example, right after he was elected in 2016, he bashed Mexico, and the Mexican peso got annihilated. He may come out and say, "Hey, Mexicans, they're our friends." So we just have to brace ourselves for having a lot of things thrown at us at once.
Mm-hmm.
And I think what we can expect is market volatility, and it might be very hard to bob and weave with all that volatility. So as an economist, I'll be looking at the data, and then I'll be in touch with the transition teams that work on the actual policies to come out. So that'll be an important period through the end of January.
And if I could add real quick to that, so you bring up a good point, Mickey, about Mexico. So, everybody's talking about tariffs, and again, you can debate what effect they ultimately have, whether it's inflationary or not, obviously, and that's fair. But everybody talks about tariffs like they're also like they're going to happen. That's another thing that people aren't really discussing, right? Everybody's just like, oh, Trump said there's going to be huge tariffs, and he's going to put them in. Now, mind you, if you look at his last administration, he did put on tariffs on China, for example. A lot of them still exist, if not all of them. So yeah, he certainly will. He certainly has done tariffs. But the other aspect of it is Mexico, where if you remember, there was I remember very well because I was trading it at the time. Basically, Mexico, Trump announced tariffs on really huge tariffs on Mexico. I think it was on a Wednesday, and by Sunday, that threat was gone. Right, so dollar Mex rips higher, and then by during the week, and then Monday, complete reversal, right? So and he's that's the other thing. It's not exactly a black box here. He's very open on how he negotiates, right? He threatens everybody with rather dramatic measures until he gets his way, and if he doesn't get his way, he maintains them. If he does get his way, he completely goes backwards. So that's why I always talk about the buy the rumor, sell the fact thing, because everybody's getting concerned about a Trump victory and what it can mean for tariffs, et cetera. But he's an open book about this. He has a strategy. Regardless if what anyone's opinion on it is, it is a strategy, and he uses it. So seeing acting as if it's a lock, that if he's announcing that he's going to do 100% tariffs on everything in China, and that's what's going to happen. Period. It's not necessarily the case, right? It's a rhetoric too.
Let me bring up one other point, Tom, before I'm going to interrupt you once again.
Yeah, no problem.
And that is both Harris and Trump are going to be hard on China. Both of them. And let me bring out a statistic that many people are not aware of. Trump's known as slap tariffs on people. Are you aware that the Biden administration has collected almost twice as much in tariffs than the Trump administration did? Almost twice as much. They've not only kept on the Trump's tariffs that they regaled against, but they've added to them. And then once again, Canada and Europe have assessed tariffs on China, and that's the environment we're heading into with a global environment where global trade has completely flattened out, and it could get hit. So both candidates, regardless of who wins, are going to be negative on China, and it'll exhibit itself in different ways. Tom, go ahead.
No, actually, you answered almost all the questions that were on the post. So I think we are in good shape. The only other thing that was left was around timing. So we We have all the tensions, Middle East, elections, Fed, 4 events happen within 4 days of the election. When people are looking to make decisions, whether it's do nothing, hedge with forwards, hedge with structured, or somewhere in between, how do people determine when is the best timing to hedge? That was kind of a thematic of a bunch of questions, and that'll be the last question we have time for. So maybe to Eugene. Eugene.
Yeah, so I always talk about timing. Timing is an interesting thing, right? Because ultimately, how do I put it? It becomes a matter of, I kind of touched on it in the beginning, but it becomes a matter of what your view is on the market. I would argue, I've had conversations with clients before where they'll say, let's say they decided to choose a structured product instead of a forward, and the market moved against them, and they say, okay, well, I shouldn't have done that structured forward. Well, really the question is, you shouldn't have hedged, right? Because realistically, all hedges, whether they're forwards, whether they're, forward extras, TARFs, if whoever's familiar with that stuff, regardless across the board, all hedges improve and get worse directly with spot, right? So really it's a question of, what is your interest on timing, right? What do you think is, do you personally think that the U.S. dollar is going to go lower or higher? And if you want to be cheeky, essentially, or call what you want opportunistic with with putting on your hedges. So I would argue it's a bit of a dangerous game to play with timing on hedges, because at the end of the day, how do you time insurance on your home in Florida, right? Like are you going to wait for hope that this season there won't be hurricanes for 5 years, and then you go, all right, fine, it's cheap enough, I'm going to buy it now. That might work out for you, but at the end of the day, we're talking about insurance here, and is it worth playing games with insurance? So I would argue timing is, we certainly have a lot of clients that are tactical, and there's absolutely nothing wrong with that. It's just, it's the degree to how tactical do you want to be. Do you want to maybe say, hey, I have out of my 100% of hedging needs, maybe 25% of it I'll just lock in now. Maybe another 25% I'll lock in within the next 3 weeks, and the balance I'm just going to wait for market to move in my favor. That's probably a little more measured approach, but I'd say trying to time hedges really is a tough thing to do. One of the benefits of structured products is that even if you don't want to time your hedges, even if you don't want to risk that the market moves against you, and you say like, well, I want to put on a hedge right now, but I am concerned about my poor timing of it. Well, what you can do, like I said, you have participation with a lot of products in structured products, right? So that gives you that protection where, hey, even if let's say you're a dollar CAD seller, you put on a hedge where you sell dollar CAD and then dollar CAD goes higher. Well, guess what? If you did a forward, you're locked in. If you do structured products,
sure, well,
you still have some protection. So that's my perspective on timing. It's you got to kind of play from both sides, really.
Fair enough. Well, with that, I think we're going to conclude today's webinar. I really want to thank Mickey and Eugene for taking the time, and for all the participants. A couple things. One, we'll have a recording of this, and if you registered, we'll send it out to everyone. Number two, if you haven't already, go to our website and sign up for our daily updates to kind of keep up with things, especially over the next 15 days going into the election. And then number three, if you have any questions around any of the discussions we had here, feel free to reach out to your dealer, and we'll be happy to assist. Thank you, everybody, for participating, and have a great rest of your day. Bye.
Take care.